Hey, Jared, thanks again for being with me today. I want to talk a little bit about tax costs that are kind of a part of mutual fund investments. So if like, and again, we're talking about millionaire investors here because that's who your firm caters to. What do millionaire investors experience when they buy a mutual fund in terms of tax costs?
Hi, great. I'm happy to be talking about taxes. My background's accounting. I came from a public accounting firm. I think taxes are cool, and the reason why I think taxes are cool is because they're controllable. When you talk about $1 million investor in a mutual fund, you think about a mutual solution with lots of positions in that mutual solution, and within that solution, there's buying and selling. We call it turnover. There's natural buying and selling within the mutual fund. Not necessarily the investor wants to buy or sell something, but within the mutual fund, there's natural buying and selling. And that creates a taxable event. So when you think about a typical wealthy client, they have a lot of taxable assets. So most of the time, those mutual fund positions are trading in a taxable account, creating a taxable event. When you think about an overall perspective of an investment objective for an overall client and their portfolio and their whole household, you might have multiple accounts, taxable accounts, trust accounts, individual brokerage accounts, IRAs, 401ks, qualified and non-qualified accounts. When you have the ability to use individual positions, you can be very, very specific with asset location. Where do I put this asset? Where do I put this income generating asset? Where do I put this growth focused asset in an effort to get the most bang for your buck, the most return with the least amount of risk? And the reason why I think taxes are cool is because normally when you talk about getting more bang for your buck, we're saying, okay, Mr. Investor, let's take more risk to get more return. But when you're very smart and thoughtful about asset location and proper tax management, you can get more after-tax return with no additional risk. And that's what we call tax alpha. And that's one of the big things what we do and we focus on, because we can get a client additional return without additional risk. That's a great answer for the client. And on top of that, most clients come to me and say, I hate taxes. So we're eliminating something they don't like, and we're giving them better after-tax returns without additional risk. And that's why taxes are cool.
Yeah. And I know I've seen a couple of times over my career where, the stock market might have a more pronounced downturn. And a lot of investors, if you're in a mutual fund, a lot of investors in that mutual fund, if they panic, if they don't understand what's going on, if you understand what's going on, you want to just wait and allow it to go back up. But a lot of investors, unfortunately, may withdraw their money from that fund while it's down. So, you might be invested in that mutual fund and other investors are withdrawing because they're panicking. Well, those withdrawals cause the fund manager to have to sell shares of securities, which may have appreciated over the years. So when they sell those shares, it causes a taxable event, a taxable gain, and that gain gets passed to everybody in the mutual fund proportionately. So you might be the buy and hold investor, but because other investors are panicking when the market's down, now you get a 1099 tax notice in the mail. And I've seen this a couple of times in my career where you have a downturn and then the next year clients are saying, wow, why am I getting these 1099s and paying these taxes, these additional taxes that I'm not accustomed to seeing year to year? And you have to explain to them, well, this is what happened. And I guess that happens, that's part of the deal when you're in a mutual fund. But when you're in your own portfolio of individual securities, like the portfolios that you folks at Rockdale create, you can avoid some of that.
Yeah, you're absolutely right. And just to kind of restate it, because it's such an important point what you're making, when you buy a mutual fund, you're buying a mutual share of all the positions in that fund, but also a mutual share of the cap gains in that mutual fund. So when other people sell, not you, but other people sell, you get your proportional share of those cap gains. So the example you gave is absolutely true. There can be years where your mutual fund portfolio is down, it's negative, it's lost money in the markets for the year. You may be contributing or not taking any money out, but because other people sold, you get your share of those cap gains. You could have a loss for the year and cap gains. And back to a multi-million-dollar investor, you're likely at a very high tax bracket. So another thing that's interesting about mutual funds with that prospect, when you use individual positions, it gives you the luxury, the absolute luxury of saying, if I sell this position, what does it do for me from a tax perspective? So we're talking about losses again. If you have individual losses and the market is down, so on paper you're down, your statements are down, you haven't sold anything yet, you have the luxury of saying, wait, I could sell Coke that's down and buy Pepsi, they're highly correlated, and get a cap loss. And that could be a tax gain for me essentially, because now I have a taxable asset with that loss. But if it was a different situation, that asset was at a gain, you might say, you know what, I don't want to sell this asset because it's at a gain position. And back to the luxury, you have perfect information because you're in control of your positions. In a mutual fund, you don't have control. And that's really the luxury of having individual stocks and bonds. And I talk about this to clients all the time. You can have a mutual fund portfolio if you want, but you're giving away advantages such as, you know, the luxury of having a perfect view from the taxation perspective. And then if your personality changes, your goals and objectives change, you can be very specific in what you buy and sell to meet your goals and objectives without having, you know, being very thoughtful through the process. With the mutual fund, you just don't have that luxury whatsoever.
Yeah. So great information. I know we've helped a lot of clients together that are the higher net worth clients, and it's been great working with you over the years, and hopefully somebody watching this will find this valuable. And if you do have questions and you want more information, certainly give us a call.